We now move to a panel discussion with our experts. May I now call upon to the stage Mr. Gaurav Doshi, Head, Discretionary Fund Management at 361 Wealth and Asset Management, to lead a panel discussion with our esteemed speaker today, Mr. Neelkanth Mishra. Joining us on the panel, we have Mr. Rakesh K. Singh, Group Head for Investment Banking, Private Banking, International Banking, Digital Ecosystem and BaaS at HDFC Bank. Mr. Singh brings over 31 years of experience in areas such as client relationships, debt and equity capital markets, wealth and private banking, structured finance, international banking, and proprietary investment.
So Neelkanth, let me just pick up a little bit from, a couple of points on the presentation you made. Very insightful, but obviously the most obvious chatter right now, which is tariffs, you have touched upon it. But, you clearly talked about the fact that investments typically take a hit in such a time like this. We all were thinking private capex revival in India could just be around the corner, potentially got kicked down the road. You talked about the currency impact also emerging. So specifically India specific, which are the sectors do you think that, could be low-hanging fruit from a beneficiary point of view in light of all these type of movements, or which are the ones that could adversely get impacted?
So let's take a step back, and from a 4 trillion economy, suppose we were to at some point of time become a 20 trillion economy. Now the bulls will say this will happen in 20 years or 15 years, the bears will say it will take 30 years. But at some point 4 trillion will become 20 trillion. So we are going to add $16 trillion of GDP. I can bet you that not more than $1 trillion of that $16 trillion will be from exports or change in net exports. Today, China, despite being the most dominant manufacturer the world has ever seen, has a goods trade surplus of $1 trillion and a current account surplus of about, it's debated, but $350 to $400 billion. Now, trade openness helps through the productivity channel. The demand, so a large part of demand generation in China has been from domestic sources. So I think that demand sources like real estate, because it's a very large part of any household's lifetime investment, the growth of urban infrastructure, 80% of infrastructure that India will need in 2050 hasn't been built yet. And clearly, I think the resolve, and I can see the chatter now shifting, policymakers are, you can see that in the budget this year as well, the urban infrastructure, the competition that they have created among states. So in the next 5 to 7 years, I see the recovery will still be investment driven, and the biggest opportunities would lie in beneficiaries of that market. As we open up, I think the world will become more fragmented, there will be more bilateral agreements and less multilateral agreements, but as we will be forced to open up, remember that we have the highest tariffs, among the highest tariffs in the world, and as that happens, I think the competitiveness of many of these businesses will be tested. So there may be more risks, but I would see the opportunities more on the domestic demand side.
So then I want to talk about another thing you mentioned, the fact that you get up every morning now looking at Twitter. You rewind back about 18 months, 24 months ago, every night we'd stay up on Twitter thinking about what has the Fed said, what has the Fed done, what is the Fed going to do. Now we're waking up every morning thinking what has Trump done, what has Trump said, what is Trump going to do. So the question here really is that, has the era of monetary policy dominance ended and has fiscal policy taken over?
100%. I think it's a great question. I did allude to partly in the presentation that the US has moved from a tight fiscal, loose monetary policy to a loose fiscal, tight monetary policy. And this is something that, when in the Biden administration, as part of a committee called ourselves the New Bretton Woods Group. So I got a chance to interact with someone in Biden's team, and they were saying that, look, the policy we adopted after the financial crisis, which was persistent low interest rates, and some kind of fiscal tightening, though of course the debt to GDP kept rising, but they kept the fiscal tight. It did not work. It took 7.5 years for unemployment to normalize. It created a lot of wealth disparity. Inequality went up. And therefore, we've now turned it. See, that's the good thing about Americans. I mean, they can keep teaching theory to everyone else, but they're very pragmatic people. So they now turned, and therefore, what that means for us is that the era of 2% 10-year yields is now behind us. And when these things change, and if you go back 300 years, there are cycles where for 15, 20 years you have very low interest rates, and then something changes. And the whole world then has to adjust around it. When Europe tried to do the same in the 1890s, and America was an emerging market, it had to really cut down on many of its investments because the cost of capital just shot up. So this is something that I think we have to assume as we go forward. And frankly, on the currency side, there are many risks, but I'm sure we'll discuss that.
So I think we have to address the elephant in the house, right? I mean, you briefly touched upon the currency liquidity on one of your presentations. Prashant talked about the fact that how FIs seem to have misread the net profit. But I mean, you have worked with many foreign investors. What is your outlook on the flows, and what are you hearing from them?
So, see, the foreign investors that we talk to are also agents. They're not principals. The principals are the asset allocators. The asset allocators are fairly straight-minded, simple formula people. That if the US Treasury yield is 4.5% and the world is looking very risky and dangerous, I want to go and hide in a US Treasury. Now, you can keep telling them that, look, the yield is high because US fiscal is unsustainable. It's like an asteroid going to hit at some point. The US regime, the government wants to devalue the dollar. You're going to be very risky. But, no one loses a job for buying US Treasuries. And therefore, the asset allocators are shifting hook, line, and sinker to US Treasuries. And therefore, a large part of the outflows we are seeing are not so much a sell down of India as it is a sell down of emerging markets. And so there is a giant sucking sound, and as dollars shrink, because remember that the US is still doing quantitative tightening, and the government keeps doing a lot of fiscal. So therefore, the availability of dollars outside the US is shrinking, and this is something that is, and so when are they going to come back? I think it's whenever you see the risk aversion ease. So whenever this muzzle velocity of Mr. Trump eases, we start to see some predictability on what things are doing, where the world is headed. That could be a few months away, but then things will settle. And frankly, this is where growth is higher, earnings growth is higher. Now the valuations are much cheaper. In fact, what I wanted to show was that the PE premium to the world is now well below average. So India, on that basis, is actually a much more attractive market now. And once the earnings cuts that we are seeing start to ease, see, we are every year, 1 or 2 year forward, consensus estimates 13 to 15% earnings growth. So every 3 months of roll forward, you gain about 3 to 3.5%. In the last 2 quarters, we have seen earnings disappoint so badly that the consensus earnings have been cut by 3%. So whatever you are gaining in roll forward, you are giving away in the cuts. So when the liquidity normalization happens, the economy sort of, I think it has bottomed out. I think forecasts in the economy have bottomed out. For the growth to get back to 6.5%, 7%, we need liquidity to get easier. Maybe that's 3-4 months away. Once earnings cuts ease, and my sense is June quarter will be that quarter, then the projection, the forward earnings start to grow, and then the market will start to revive. And that's when I think the FII flows can start to come back.
So potentially at the near end, at the end of the tunnel of the FI selling, but it's been relentless. And I can't let you go without asking you a little bit about AI. I know there's going to be a bigger session on it, but it's staggering when you see the amount of spend lined up by companies and countries globally on AI. It's just mind-boggling, right? Now, this level of investment has the ability to, alter, reshape industries, reshape labor markets, literally reshape global economic growth. So from your perspective as an economist, right, what do you make of this? And more importantly, how do you think this will influence India? And given, our demographics and economic trajectory, how does that kind of have any impact for us sitting over here?
I could have spent an hour talking about it, but I'll keep it shrunk to 2 minutes. Yeah, so see, I see the impact of AI on the economy in three parts. One is invention, second is innovation, third is diffusion. That in the first part, you develop the large language models or the AI engines. The second is you use those AI engines to build business solutions. And the third is you diffuse that, you make it available and accessible to more and more people in the economy. Just to give you an example, whatever happens in AI, even if say agricultural productivity can go up a lot with AI, getting it to the 15 crore, 13 crore, 12 crore, 11 crore farmers in India is going to take a very long time. So the faster we can get it to diffuse, the more the economic impact is. And that's why I think most technologies take a very long time to have economic impact. See, you and I will keep obsessing about it because our lives are getting changed, but we are a very small part of GDP. So diffusion is actually the most critical part, which takes the longest time. You look at the first part, which is what is getting the most excitement, which is hyperscalers, NVIDIA, chips, and algorithms, and so on and so forth. Look at what Satya Nadella said. He's saying that I am not getting now into this rat race of setting up more and more capacity. I would be happy leasing it. So he can sense now that there's overinvestment happening there. So as we think about, I mean, we have to have our own large language models. I think that's from a strategic autonomy perspective is very important. But remember that most of the value will come on the innovation side. So as internet got built, it was the last big general purpose technology that hit us. Akamai Technologies or Cisco, reached a certain level of market cap and revenue and profits, but it was the Metas of the world, the Googles of the world, Amazons of the world, which built solutions on top of it, which actually create a lot of economic value. So that's where I think that, and frankly, in the next couple of years, I would see a very sharp fall in the cost of queries. And as the AI engines become much cheaper, they're already getting cheaper, I think that's when some of the really hard business solutions, like say an Indian generic company becoming much more capable of innovation. See, today it costs $1 billion to identify a drug. Maybe AI will bring it down to $30 million. A lot of Indian companies can participate. You can start doing chip design. Today, an advanced chip design takes $600 to $800 million. Maybe it'll fall to $20 million, and Indian companies will start doing it. So there'll be lots of good opportunities that start to come. I can keep talking about it, but maybe I should stop there.
No, thanks so much. So Rakesh, over to you. I'm sure you've been having a lot of questions put forward by investors in the last couple of months, but I think it's important to acknowledge the fact that you and your team deal with pretty much the entire spectrum of wealth in this country, and even from a geographic point of view, literally the entire spectrum of this country. So first question is, how are investors responding to the current market turmoil? And more importantly, what is the advice you're giving them right now?
So I think everybody's talking about carnage everywhere, bloodbath everywhere. So nothing unusual about talking about a bloodbath. But, people love excesses like drinking, but this is the after effect of, having a hangover. So this is the hangover after a lot of drinking. And the markets have come back to some kind of a normalcy where I think the valuations tend to reflect what the underlying fundamentals are. We continue to believe that, systematic investing is a good habit, and, you should continue with that. I have a slightly contrary opinion because I think a lot has been talked about mid-cap and small-cap. But what is getting missed is two very fundamental aspects. One is that actually, if you look at the companies which are 250 and beyond, if you look at today, for example, I was just looking at today morning, you have a company like Go Digit which got listed, It is a challenger general insurance company which is coming up. It is a small cap company. How many of us don't believe that the company is going to be around there, right? We have 251, 252 is Apollo Tires, one of the second largest tire manufacturers in the country. These are small cap companies today's definition because their market cap is less than 30,000 crores. Do you think these companies are not going to be there tomorrow? Are they not good? So the valuations go crazy is a different matter. That is first. So there are underlying challenger business models which are emerging out in the small cap universe. So the challenge now is not generic. It is the challenge is that an individual fund manager will have to show that amount of understanding of business models to find out those winners which will migrate from small cap to mid cap and mid cap to large cap eventually. The second trend, if you want to see, is there has been periodic reshuffling between large cap to mid cap to small cap, and you've seen companies moving away from small cap to mid cap to large cap. Okay, so you will see gradually companies moving from small cap to mid cap to large cap across, as and when their valuations keep increasing, their business models grow. Lastly, but nonetheless, I would like to share with the larger audience here is that some of the companies which are services sector companies here, a lot of people from IT here, we were at some point of time were small cap companies. Okay, so if you don't look, if you look at them, large companies which we are talking today, which are some of them are part of Nifty as well. We were small cap companies 20 years back. So let's not lose faith on small cap companies. A lot has been written on valuation of small cap companies, but this is not the death of small cap companies.
So remember the business model, but be careful of the price you're paying for it. Okay, good.
Always true.
Okay, Rakesh, another thing that I think everyone's been talking about, right, and a lot of chatter of late is the fact that the domestic equity flows. Now, what are your thoughts on what's your sense on the flows that we're seeing? More importantly, what are your thoughts on the SIP? It's been a tremendous success, but do you really see that momentum continuing in this type of volatility, or how do you see that playing out?
I think most customers we meet are very happy to see moderate corrections. They couldn't understand the excessive valuations around. So it's perfectly fine that these corrections come through. Now, when a market like this, there is a sell-off happening, there's nothing called a balance. When people turn bearish, they tend to sell. We understand that currently in funds, people are selling, trying to build cash in a falling market. So obviously, their corrections are sharper than what they should be largely, because people are, especially small cap funds, mid cap funds, are now building cash for redemption. Now, if you look at today, I think people should keep on investing periodically. We haven't seen SIP flows coming down dramatically. There may be a 10% correction here or there where people have done. On a distributor model, definitely, it has continued. 90%, 80-90% SIPs continue. On a direct model where people were just, mindlessly applying something, there could be challenges there. But I think wherever there are investment advisors and people advising clients, everybody, even this August audience, will try to, convince you that investing systematically will give you, which is what Prashant also said a little while ago, investing in Nifty will definitely be a far more profitable way of investing your money.
So let me just bring a little bit of what Prashant talked about, but he talked about fixed income returns, how sort of the tax disadvantage further emphasizes that disadvantage. So a quick question, but is the 60-40 portfolio dead?
So 60-40 used to come in a regime, historically was practiced depending on, because people always got rich towards the, latter half of their lives. I think investment surpluses have started coming in early to a lot of people. So if you are, let's say 50 plus, then that may be a different ratio for you. But if you are 65, 70 plus, a 60-40 seems reasonably logical to hold. Market corrections like this tend to give you a good window to reflect that if you look at if interest rates corrections happen now from where we are at, let's say today at 6th quarter and then going towards a lower cycle, then fixed income returns will actually on a capital gain basis give you a slightly higher return than what they have given historically. Likewise, equities are now, large cap equities that people are expecting, as you heard Prashant says, 8 to 12% kind of a return, on a zip code of that is what people are expecting. So there will be periods where, gold, fixed income will give you returns. A great instrument is, I think, hybrid funds. They have all been performing reasonably well. I think that should form a part of the 40%. But I think a 60% equity allocation seems logical.
So to conclude, a one-word answer, apart from equity, which is another asset class you're positive on?
I would definitely recommend REITs and InvITs as a part of people's portfolio.
Very interesting. And Neelkanth, before we conclude, I'm going to put you on the spot, but your boldest prediction for the Indian economy by 2030?
We should be in the ballpark of about $7 trillion in GDP by then.
Okay, so to conclude on some sort of positivity and optimism, thank you all. You all have been a wonderful audience. Thank you, Rakesh. Thank you, Neelkanth. It's been very enlightening. Thank you, ladies and gentlemen.
Thank you. Thank you.
That was truly a fascinating discussion. And thanks to our speakers for your active participation and invaluable insights.